All right, today we're going to take a quick look at understanding monetary policy and the role it plays in aggregate demand or demand side policies for macroeconomics. I find it's easiest if we really break this down and make it simple. And let's assume the gentleman on the left is you, or your boyfriend, or your brother, or however the analogy fits. And you want to buy this $35,000 new Tesla Model 3. Let's assume for the time being no government subsidies. I apologize in advance. I've got an older stylus that I'm using today. So if you want to buy that new car, you probably don't have the money to buy that outright, and you need to take out a loan from your local bank with interest. This is a very common relationship that you have probably thought through before. If you are going to take out that loan from the bank is going to want the money in return with interest. So let's say that $35,000 you're going to pay back to the bank at 3% interest. That means roughly you're paying back $37,000. That is a very simple understanding, very simple relationship. But what's key here is that interest rate, that's where we're going to use the word interest. And you'll see in a second that monetary policy sometimes makes this more difficult than it needs to be. If you have a bank and you're borrowing money from that bank, the bank also uses the Federal Reserve, which we'll put over here, or any other central bank. In other countries, it's called different things, but any other central bank, your local bank would use to also get money. So while you get money from your bank gets money from the Federal Reserve in much the same way. And just like you pay back money with interest, right, the bank pays back money to the Federal Reserve with interest. Again, here's where it gets complicated with what some of this means. There are ways that the central bank, the Federal Reserve, can affect the overall supply of money, or we're going to call it the consumer interest rate. The consumer interest rate, that rate that you got up here for 3%, that's the interest rate that the Federal Reserve is going to affect. But it's very indirect. The Federal Reserve only does things on this side. They can't directly control what the bank does to you, or at least they can't pin it down to a specific number. So we're going to take each one of these three things one at a time: the discount rate, the reserve ratio, and the buying and selling of bonds, again, just as a simple introduction. So let's start off with the fact that sort of in the background of this conversation is this supply of money graph that I'm not going to go into detail here, but if you look at the left, the supply of money graph shows that the supply of money is independent of interest rate, and the demand for money is always downward sloping, and as interest rate goes down, the demand for money goes up. So we can see that the Federal Reserve, these central banks, are going to look to change the supply of money in the economy. If you change the supply of money, you get a different interest rate. Okay? Again, not going into that in a whole lot of detail. But we'll start with the discount rate, then the reserve ratio, then the buying and selling of bonds, and you'll see how this plays out. Now, discount rate. The Federal Reserve, when they loan money to your bank, does so at an interest rate. Currently in the United States, that interest rate is a discount rate at 0.37%. The bank, when it loans you money, again, if you're looking for a car loan right now, it's about 3%, which means that your bank is making money off of you. All right, your bank has to borrow from the Federal Reserve. The bank lends to you and you pay back. But because this number is larger than the discount rate, your bank makes money. The discount rate is one way, or the changing of the discount rate is one way that the Federal Reserve can affect the consumer interest rate. If this from 0.37 goes up to 2%, that also means the number over here goes from 3% to something higher, like 7%. The higher the interest rate is, the less the supply of money. Consumers aren't going to want to buy products or use their money to take out loans. So one way that the Federal Reserve or central banks can affect the interest rate in the economy is through the discount rate. Okay, again, I'm making this as quick as possible so you can see the three different ways. It's certainly not in as much detail as you might find helpful. The second thing the Federal Reserve can manipulate is something called the reserve ratio. And at least for the time being, let's ignore this half the equation where you are with your car. Your bank and the Federal Reserve have another working relationship where if your bank has, let's say, $3 million that it's collecting from consumers in the economy, the bank then can put some of that 3 million, some of the stuff that they're not lending out to consumers, into the Federal Reserve, into the Federal Reserve Bank. In fact, the Federal Reserve requires a certain percentage of however much money the bank has to be stored at the Federal Reserve for not so much safekeeping, but as a safeguard against future uncertainty. Right now in the United States, that amount is 11%. That's called the reserve ratio. If the reserve ratio goes lower, if it goes below 11%, it means that your local bank has more money that they can lend out to you as a consumer. If the number goes up, the supply of money would also then go down. Your bank would be required to keep more of that $1 million in the Federal Reserve. So you see there's a relationship there between the Federal Reserve and how much they require your local bank to keep in their coffers or to be able to lend out to you. The last scenario here is a bit more interesting. You see we switch the screen a little bit. The consumers in banks can own or hold government bonds. A bond is just a debt that the government will repay with interest in the future. Now, it's unlikely that consumers hold these things in large amounts. It's much more likely that banks do. Here you see a $1 million U.S. Treasury bond. That's more likely something the bank would hold, but individuals can hold mortgages that the Federal Reserve will buy. The last way that the central bank can control the supply of money and thereby the interest rate is by buying or selling these bonds. So, if you hold the bond now, or the bank holds the bond now, and the Federal Reserve wants them, they can come to you or to the bank and buy the bonds from you. So if you held the bond and the central bank buys it, you get money from the central bank, or your commercial bank gets money. In that case, if the Federal Reserve is buying the bonds, they're putting money back into the money supply. Increasing the supply of money would decrease the interest rate in the economy. Obviously, this scenario works in reverse. If the central bank is selling these bonds that they bought, if they're selling them back to you as a consumer, or they're selling them back to the banks, then the money flows the other way. They can buy back bonds and create the interest rate or the supply of money to go down and the interest rate then to go up. Now, I told you it was a very quick overview, but hopefully this simple scenario, being visual, helps you understand how you interact with your local bank or your commercial bank, how the Federal Reserve interacts with your local commercial bank, and how those three things affect you.